Step 1 of the 5-step approach under IFRS 15 relates to identification of a contract with a customer. In this step, we also need to know how to deal with modifications to existing contracts. A modification would occur when there is a change in either the scope or price or both. When this happens, the modification can be treated either as a separate contract or not as a separate contract. IFRS 15 paragraph 20 requires the modification to be treated as a separate contract if both of the following conditions are met. 1. The scope increases due to additional goods or services promised which are distinct. 2. The contract price increases to reflect the standalone selling prices and price adjustments of the additional goods and services promised. If any one of these requirements are not met, the modification would not be treated as a separate contract. For example, UniX Limited entered into a contract with the Australian Army. The contract stipulated that UniX would provide the Australian Army with 5,000 military uniforms at a standalone selling price of $100. The contract indicated that UniX would deliver 1,000 uniforms every month over a 5-month period. After the 3rd month, the two parties agreed to increase the scope of the contract for another 1,000 uniforms to be delivered in the same month. The price for this was set at $90 per uniform, which includes a $10 discount per uniform. Should this modification be treated as a separate contract or not? In this example, the modification related to an additional 1,000 uniforms to be delivered. The uniforms are distinct goods because the Army can benefit from the additional uniforms on its own, and it is separately identifiable from other promises in the contract. Further, the second requirement is also satisfied. That is, the price increases reflect the standalone prices of those uniforms with the price adjusted for a discount. Since both these requirements are met, the modification would be treated as a separate contract. So for the first 3 months, UniX would record revenue of $300,000, which is 3,000 uniforms delivered over a 3-month period multiplied by the selling price of $100 each. The separate contract would then also apply in this month, and UniX would record revenue of $90,000 for the delivery of 1,000 uniforms at a discount adjusted price of $90 each. The remaining 2,000 uniforms to be delivered over the next 2 months at a price of $100 would continue and be treated as per normal. That is, it has not been affected by the modification to the scope or price. To recap, modifications to contracts by changing the scope, price, or both should be treated as a separate contract if the two requirements in IFRS 15 paragraph 20 have been satisfied. If not, then the modifications would not be treated as a separate contract. In this clip, we focused on modifications that would be treated as a separate contract.